Hi there, everybody. My name is Lee Schwartz, and I'm the Director of Business Development for SVA Certified Public Accountants. I'd like to welcome you to the third webinar in our dental series, and this one's titled Current Trends for Dental Practices. Now, before we get started, I just want to take a sec and say a few words about SVA and our history in the dental industry. Like many of you, we got to where we are by being independent. And our vision moving forward is to remain that way and continue serving the same clients we have since 1974. And a huge part of that client base over these last almost 50 years has been dental practices. Our mindset is that when you're a practice owner or practice manager or shareholder, you have to work with someone who's more than just an accountant or a tax preparer. You need someone who's a true advisor working collaboratively with you. This webinar and others like it are just one small way in which we do that. So we have a lot of content to go over in the next 30 minutes, but we are going to try to leave a few minutes at the end for some Q&A. So please send in any questions you may have as we go, but we're going to wait till the end to actually get through them. All right, let me briefly introduce our speakers today. We've got two of the most experienced people in our healthcare and dental practice to walk you through everything today. First off, we have Matt Vanderloo, who's SVA's CEO and also a principal in our healthcare group. And we have Joel Recklich, who's a manager in our healthcare practice. Both Matt and Joel work with practice owners and practice managers on efficiency, profitability, and of course, tax strategies. All right, I want to let these guys dive in. So Joel, I'm going to let you take it from here.
Thank you, Lee. Good afternoon, everybody. Thanks for taking time out of your day to watch the current trends in the dental industry. Today's topics, we'll be talking about the challenging labor market, especially employee retention. We'll also be talking about increased practice overhead, and Matt will touch on inflation and interest rates. We will also discuss decreased collection percentages, practice appointment schedule, teledentistry, IRS and tax law updates, as well as other trends in the dental industry. Now, let's take a look at our first polling question. So, what is the biggest concern for your dental practice? Is it the challenging labor market, increased overhead costs, or possibly is it decreased collections percentages? All of these are very important, but just choose one and we will try to spend a little extra time on that topic. As we wait for our results, to no surprise, the challenging labor market took 63%. Increased overhead was 13%, while decreased collections was 25%, which is great because it brings us to our next topic, challenging labor market. As you all know, it's been challenging to hire and retain staff, especially in the hygiene section. And then we're also dealing with resignations and retirement. You know, this is every industry across the board, where everybody's lacking skilled employees. We all know that. But did you know that the ADA survey reports that 1/3 of hygienists and assistants will retire within 5 years? And within 5 years, I mean, that's right around the corner. I mean, you probably already know that employee that is probably retiring soon, and you need to look at finding their replacement. This could take more time and cost more money than you think. You know, an opening in the hygiene schedule equals immediate and future production loss. To get fully staffed, a lot of offices are hiring less experienced, less trained employees, and they're also dealing with higher turnover. So you need to review your wage and benefits to the market and make sure your employees are being paid fairly. Next, we will discuss employee retention. So what can you do about employee retention? Are your wages competitive? What benefits are you offering? An ADA survey indicated that dental benefits, paid holidays, vacation, and retirement plans are very common, so you're not really differentiating yourself from your competitors. Things that are making you stick out would be offering health insurance, paid sick time, paid leave, giving an allowance for continuing education and professional development. Employees are looking for more flexibility in their work schedule. They are looking for that work-life balance. We need to give employees opportunities to grow and develop. Look at giving them more responsibilities. You need to look at building a culture that attracts and retain employees. You also may need to make sure your associate dentists are satisfied and they're being paid fairly. Make sure their base pay is comparable to their competitors. Make sure their net production bonuses are also competitive.
That's a really good point, Joel. I think as we talk about current trends, one of the really recent current trends we've seen is around associates. So I think the past 12 to 18 months, we've really thought about employee retention as it relates to hygienists, assistants, and office staff more. But in the last few months, we've had a few clients who've had some trouble with their associates, and associates who have either left the practice for what they think is a better opportunity somewhere else, or associates who are feeling some decreased level of job satisfaction, some level of burnout in the practice, and have either altered their work schedule in a practice or have left the dental profession altogether. So I think this is a new kind of bubbling issue in a lot of practices. How do we keep the associate happy and retain them? And I think the other overall theme with all of these ideas is that managing and operating your dental practice is going to become more difficult, more challenging, and more complex as you look at trying to find these unique ways to help retain employees and keep employees happy in your practice.
I 100% agreement. Next, let's talk about increased practice overhead. So as we touched on, staff wages and benefits being obviously increased over the last few years. I've seen health insurance benefits increasing from 15 to 20%. Their costs for lab and dental supplies are definitely higher than they were pre-COVID, but they might not be quite as high as they were just when COVID started and everybody was trying to find their supplies. Lastly, the newest one is the interest rates continue to rise. This could be an opportunity for you to look at retaining cash for feasible dental equipment needs, so you do not have to finance it and get an interest rate at 7, 8, 9%. Some of the old benchmarks that you might have had for staff wages and benefits or supplies, might not apply right now because the industry is changing so much. Next, we will compare the current and prior year wages from the SVA dental survey. So this is from last year to this year. It covers your staff, your assistant, your hygiene. What is the increase in their wages based on the length of working experience? So from that 0 to 3 year range, you're seeing an increase in wages of 11.3%. From that 4 to 9 year range, you're seeing 8.8% increase. In 10 plus years, you're seeing a 3.5% increase. We also have the survey broken out by geographical regions, where you'll see like the average wages for South Central Wisconsin, mainly Dane County, being the highest at $29.37, which is about $1.50, $2 higher than the surrounding areas in Wisconsin. Now let's take a specific look at the hygiene wages. So in the hygiene wages, you can see the averages. I'm going to tell you from last year to this year, from 0 to 3 years of experience, there was a 3% increase in average wages up to $37.12. In that 4 to 9 year range, we saw the biggest increase, which was $4.50 up to $38.40. And then with the 10 plus years of experience, it was about a $2 increase up to $39.55. One thing you'll notice is that there is almost a flat graph here. And you're seeing that if you're just starting out in hygiene, coming right out of school versus having 10, 15 years of experience, that average wage difference is only 7%.
Yeah, it's a really interesting observation there, Joel. I think we're seeing that gap close between brand new hygienists and really experienced hygienists, which means those new hygienists who aren't as fast, aren't as efficient, maybe don't have the skills to turn over patients quite as quickly, are still being compensated like a hygienist with 10 or more years of experience who's probably a real high performer and real high producer in any practice.
Yeah, and another thing I've noticed that I've seen a minimum of $30 for that 0 to 3 years. I'd be very surprised to see that now. I'm seeing more in that $38 range.
Yeah,
And let's see, the next slide, we can talk about the dental assistants. Now, this one seems a lot more consistent. We're seeing an average increase from 2021 to 2022, about $2 across the board. In the 0 to 3 year range, it's about $20. From the 4 to 9, it's almost 23. In the 10+ years, it's almost $25. Here you're seeing a more consistent increase, around 10% jumping from the 4 to 9 year range, and then again to the 10+ year range. To me, it's saying that, there are, dental assistants out there, they're being paid fairly, and they're given a generous increase in wages, across the board, when we're comparing that to the hygienists. Next, we will discuss wage increases. So from our survey, we asked the question, what range of increases do you anticipate giving this year? We saw a range from 1 to 10%, with the average low being 2.5%, while the average high increase was 6.3%. The majority of the respondents has said that the increase was 3%. The question I ask you is, what range do you plan to give your employees next year? Is it going to be a straight percentage across the board? Is it going to vary based on if you're a hygienist versus an assistant versus office staff? Is it going to be changed based on the number of years of experience? Those are all items that you can think about. And it looks like next we have our second polling question. So I'm going to say what new, keyword is new here. New hiring retention strategies are you considering implementing within the next year? A 401k or other type of retirement plan, health insurance, retention bonuses, other bonus plans, hiring bonuses, stay interviews, cultural changes, reduced flexible hours. So choose all that apply. And in the meantime, I just want to touch on stay interviews. I've heard of, exit interviews when employees are leaving, they pretty much tell you what you could have changed in order to keep them. Stay interviews are employees you currently have, and they essentially tell you what you could improve on while they're still working there. And it increases your chances of retaining them at a much higher percentage if you listen to them through these stay interviews. And let's see what our answers are here. It's a tie, actually. So retention and other bonus plans are at 43% each. Hiring bonuses are 14%, and stay interviews are at 50%. I'm sorry, I had to scroll down. So stay interviews, cultural changes, and reduced flexible hours are all 57%. So it looks like a lot of these are new strategies everybody's looking at doing starting the next year. All right, so next, Matt will talk about inflation and interest rates.
Yeah, thanks, Joel. So as we started thinking about things that are current trends that are really having a big impact on practices, clearly one of the big pieces is increased inflation here. As we look at inflation on an annualized basis, just through the end of October this year, it was still up at 7.7%, down a little bit from where it was at the end of September. So annualized to the end of September was at 8.2%. So coming back down maybe a little bit. Hopefully that's not just a temporary decrease, but the start of a trend here. But the thing to remember is that the Federal Reserve is really targeting no more than 2% for inflation. So even coming down to 7.7, it's still well above that Federal Reserve target, which means the Federal Reserve is going to start to pull the levers it has at its disposal to fight inflation and continue to pull it back down. And the big lever, the big place we're going to see that is in interest rates. And if we look at any of these important interest rates today compared to where they were 1 year ago, we see big increases. The prime rate went from 3.25% up to 7%. The Fed funds and Fed discount rates went from 0.25% all the way up to 4%. And I think if we look out further into the future, the prognosticators that are smarter than I am are seeing even further interest rate increases potentially coming yet this year and in early next year. So I think we're going to continue to see interest rates rise. As long as we're seeing inflation, we're going to see continuing increases in overhead costs, whether that's supplies, utilities, whatever it might be there. But these increases in interest rates are going to have a cascading impact throughout the economy and throughout practices. We're going to see higher mortgage rates. If you need to refinance a building loan or a home loan, or you're buying a new home, putting up a new building, the cost of borrowing to do that's going to increase. Any equipment loans you need to do, we're going to see an increase there. If you have a line of credit in your practice, we're probably seeing an increase in that interest rate as well. And if you're a relatively new dentist, if you haven't consolidated all those student loans yet, consolidating those is probably going to result in a higher interest rate now than it would have a year ago, which is going to mean we're managing practices a little bit different, managing personal finances a little bit different. We might be doing things in practices to retain more cash so that we can just buy the equipment instead of having to deal with a lease or a loan on that equipment and dealing with an increased interest rate. As we look at having excess cash, which piece of which piece of debt we decide to pay down first might vary. Since some interest rates on these new loans are going to be much higher, we might pay off newer loans first before we would those older loans. And if you've got an existing home mortgage from a year or two ago, that might be a piece of debt that never gets touched again, and we let it play out its whole 30-year life or its whole 15-year life, just making the minimum monthly payments. So lots of things to think about on the interest rate side. And as we think about those increased overhead expenses that are coming from inflation, what can we be doing in the practice? As we look at the supply side, it might be a smart idea to put a staff member in charge, one person in charge of ordering supplies and giving them a budget. So they know exactly what range they're trying to stay within, and they can manage when they're doing buys, how they're doing buys to try and take advantage of any discount plans that might be out there with your dental supply house. Maybe there's a bonus plan in place for that staff member to make sure if they're staying within certain norms and certain ranges that they're getting some benefit from that. We might want to look at negotiating a discount with any of our vendors if we're making early payments to help reduce that cost. Or if we can't get any discount, maybe we're doing everything we can to pay as slow as we can and keep that cash in the practice as long as we can. Maybe getting a CEREC or a 3D printer into the practice to help cut down on lab fees and lab supplies might help. We might want to take a look at our credit card processing agreement. The ADA's got a great member benefit out there with Best Card that can cut processing costs significantly in some practices, depending on who you're using right now. So that might be an opportunity to take advantage of in your practice. If you're leasing your space, I think what we're seeing right now is that there's a ton of excess commercial space out there, and landlords are really getting a little bit more aggressive about renegotiating and extending current leases at pretty favorable rates to make sure they've got tenants locked up for a while. So this might be an opportunity to take a look at the space and your rent cost. And then on the billing side, if you have any questions or any uncertainties about how you're billing, this might be the time to have somebody come in, review how you're coding, how you're billing, and make sure you're really getting paid for all of the work you're doing with patients. So plenty of things to consider and think about there. And on that billing piece, as you're looking at billings, one of the other really big trends we've seen so far in 2022 is that collection percentages are really starting to fall and come down in practices. Even practices that have been historically pretty stable in their collection percentage are seeing some decreases. And really, this is the impact of insurance companies not increasing their reimbursements in a number of years, a decade plus in some cases. So as practices experience those higher overhead costs, higher input costs to providing dentistry, and increase their fees, that reimbursement stays the same and collection decreases. We have some additional information from our salary survey here about fee increases. Almost all practices are planning on doing at least one increase this year. Some practices doing two. So almost 90% of practices are doing an increase this year, averaging over 4.5% for their increase. So everybody's increasing their fees to try and keep up with all the increases in input costs in their practices. So that decreased collection percentage, what we're seeing is that increase in fees, because of all that outside pressure, means that there is with no increase in reimbursement, that we're really flat and decreasing on collection percentages. So think about all the bonus plans, all the compensation formulas in your practice. Let's try and transition those, make sure they're structured on net collections, not on gross production, so that they're really tied in with the cash coming into the practice. And then if your practice doesn't have one, a dental membership plan is potentially a great way to help combat that decrease in collection percentage, get more cash paying patients, more patients that aren't tied to an insurance provider into your office and into your group. Joel, how does that look then on the practice appointment side, and what are we seeing in practice schedules?
Well, in practice schedules, we have two lines here, just if it's hard to see. So the bottom blue line is the national average for appointments. And the orange line is Wisconsin. I should have made that red, that's my fault. So we're looking at 2022, January through August, with January being kind of a low period for appointment scheduling, being between 82 to 84%. But the biggest things that we're seeing in terms of issues in filling the appointments is one, not having the staff to do it. Two, not having enough patient visits. And three, having no-shows or cancellations. So if you're dealing with no-shows or cancellations, you could look at feasibly having some type of cancellation fee if they don't cancel within 48 hours, essentially giving you a chance to fill that appointment. Next, we'll talk about teledentistry. Teledentistry is fairly new to me. I've dealt with it in the medical industry quite a bit. And then things that teledentistry is doing is helping with pre-appointment consultations, improve referral experience, boosting productivity and efficiency, expanding patient reach in those outlying areas. And then with triage cases, you might be able to determine if a patient needs to come in today versus tomorrow, just by taking a look at their mouth and figuring out, the severity of the issue. And now it's time for our last polling question. What is your practice's approach to teledentistry? We are an early adopter and use it often. We've just started but are not utilizing it to its fullest extent. We're considering it in the future. We are unlikely to use teledentistry at all. And like I said, in doing research for the current trends in the dental industry, every top 10 list I saw included teledentistry. So we figured we'd include it here, even though I think it's just picking up the grounds right now. And see, and our poll results are pretty much, let's see, nobody is using it right now. 22% are considering using it in the future, and 78% are unlikely to use teledentistry at all. Next, Matt will discuss taxes and the IRS updates.
We don't like to let any opportunity go by when we're talking about current trends in any industry to not talk about about taxes and the IRS just a little bit. Based on some of these early results we're seeing from last week's elections, almost only a week ago. What we're thinking is I don't think there'll be much in big changes, any significant changes yet in 2022 or even for 2023. It seems like things are still pretty well divided in Washington. It's going to be tough for anybody to get enough momentum on many topics to get much move forward. I think the one exception we could see here would be what's being referred to as Secure Act 2.0. It's going to be mostly retirement plan, IRA related. I think some of the big provisions we could potentially see in there that will have some impact on dentists, dental practices, is an expansion of automatic enrollment for employees. So more employers being required to automatically enroll their employees in retirement plans once they join a practice. Some modification of the credits that are available to practices and small employers for implementing new plans. And then for any of our retired dentists or anybody who's getting close to that retirement age, we might see that required minimum distribution age push back in the next few years to eventually move it back to 74, 75 years old. I think one of the other trends we're seeing more at a state level across the nation is that more and more states are putting in place mandatory requirements to have a retirement plan in a business. So right now, California, Colorado both have laws on the book. books. Wisconsin currently doesn't have anything, but that could be something we see develop at a state level at some point in the future. The state of Wisconsin requiring Wisconsin employers to have a retirement plan in place and available to employees. So that might be on the horizon. If you don't have a plan right now, that you might be forced into putting a plan in place. And then a little further down the road here, we're currently operating under some pretty favorable tax laws because of the Tax Cut and Jobs Act from 2017. That is set to expire at the end of 2025. So barring any legislative action in 2026, we're going to see all those changes go away, which is in almost all cases going to mean higher tax rates for individuals on their returns, and changes that are going to be not favorable to taxpayers. There are a ton of other trends going on out there that we just couldn't quite squeeze in here and address. All sorts of things that are impacting practices in positive and negative ways. One of the ones I want to hit on is just real quickly is consolidation. We're continuing to see a ton of consolidation in the marketplaces we work in and in dental in general. Consolidating into larger groups, still lots of private equity activity, lots of PE firms acquiring and rolling up practices into much bigger groups. So no sign of slowing down there on the consolidation side, and still a ton going on. With that, we've left a few minutes here at the end, so I'll let Lee hop back in.
Somehow you guys left time. I feel like every year we do some version of this webinar, and it feels like there are more and more and bigger issues, and you guys somehow managed to fit it all in 26 minutes. So nice work. A lot of information to cover. We've had a few questions come in, and we got a few minutes to go over these. If anybody does have any additional questions, send them in now. We'll see if we can get to them. But let's start with the first one here. So this came in during the dental survey piece. Somebody's just asking, where do we get a copy of the dental survey?
Great question. So at SVA, we do this dental survey every year, typically start the process in August, and we send out the full results to all the practices that participate in the survey and send us their information to be included. So in the future, if you want to make sure you're getting the results, please make sure you're signing up for and participating in that survey and providing us your salary information. We do have an executive summary that we can send out to anyone if you want the high level results from that survey. So reach out and let us know if you're interested in that. If you're interested in the full results, we'd love to talk about that. Love to sit down with you and go through the survey a little bit and find out a little bit more about your practice. So happy to do that too if you want to reach out to us.
Great. And we did do a webinar on that last month as well. So definitely information out there. Okay, we've made another question that came through. We've made improvements in our benefits and have added some new ones, but I keep hearing about culture. What are practices actually doing to improve culture? You guys want to hit on that? I know it's a little ethereal.
Joel, what are you seeing in the practices you're working with and talking with?
I'm noticing that, with being able to take advantage of like restaurants and meals being deducted at 100% through this year, or that there's a lot more employee outings, a lot more lunches being brought in for staff. There are, gift cards, like for random awards that they can be given. Just in general, just more money being spent on the employee side.
Yeah, I think there's lots of things like that are happening in practices to try and make things a little bit more fun, give maybe employees some more rewards out of the practice too. I think on the philosophical side, what we're seeing some practices try and do is be a little bit more transparent about what's going on in the practice from a management standpoint, and not necessarily involving all the employees in the decision-making process, but giving them some more insight into the issues and how we went about deciding on those issues and thinking about those issues, and working on transparency, working on trust in the same way, so that employees have a good idea where the practice is going, what the owner's thinking, and have some more trust in how decisions are being made and what decisions are being made. I think there's a lot that can be done there. A lot of it's very difficult and takes some time to build up and get going. And it's really going to be very individualized to each practice and what makes sense and what the owners and leaders in those groups are passionate about and how they can move the group forward.
Great. Okay. All right. We have time for one more question. Oh, and you're going to love this one. Nothing better than putting you on the spot and put your prognosticator hat on. The question is, when do you see insurance reimbursements increasing?
It's a great question. I wish I knew the answer to that because I think I could charge a lot if I knew the answer to that. And this is being recorded, so maybe I can't be too fully honest in case it comes back to haunt me. I'm not overly optimistic that short term, next 12 to 18 months, we're going to see a big change in reimbursements from insurance companies. I think there might be some playing around the edges potentially this year. I think there's a lot of pressure on some of the big dental insurance providers to do something on the reimbursement side. So they might try and do something minor to show that they're doing something. But I don't think we're going to see any significant changes for a while. I know this is a topic that's very important to the ADA and the WDA, and there is work going on in a number of different state levels and at the ADA level. So I think over the next few years, we will see movement here and that we will see some increases in reimbursements, but I think it's going to be a few years before that falls through and we see any significant changes there.
Well, you can feel better in that at some of our past webinars, when we're talking about tax topics, people are asking us for what's going to happen with the next Congress or what new legislation is going to pass. So maybe this one's a little bit easier than that.
That's true. And, on just to give everybody some view into my prognostication skills, I've been at SVA for 22 years. For 22 years, I've been saying interest rates can't go any lower. And here in year 22, I've finally been right. And interest rates have started to go back up. So eventually I'll be right.
All right, great. Joel and Matt, lots of great information. We're actually a minute past time, so I want to wrap it up. But I do just want to mention that you can go to sva.com/dental series to sign up for the other webinars in the series. And you can also find news and information that may affect you and your practice. Our next webinar is on December 14th, and the topic is get ready for a buy, sell, or owner transition scenario. So please sign up for that. And lastly, I just want to remind everybody that the SVA team is only a phone call or an email away. So if you're a client, reach out to your SVA professional as questions arise. And if you're not currently an SVA client, you can contact me, Lee Schwartz, or anybody else in our business development group so we can get you the help or the answers that you need. Thanks for jumping on today and hope you enjoy the rest of your afternoon. Bye-bye.